GM, good morning. Welcome to the Milk Road Show, the daily crypto show that just went from rock bottom to we are so back, baby. I'm your host, Jay Hamilton. It's Monday, March the 3rd. Holy Jesus, March. What's happening this year? Today, we are talking first, we got to talk about the bounce, everybody. We bounced over this weekend. We are so back. What is going on? We're going to touch quickly on markets, but today's episode is really all about stablecoins. Now, why are we talking about stablecoins? I know everybody listening to this episode is like, I don't care about stablecoins, Jay. Talk about Bitcoin, talk about Ethereum, talk about the tokens that I can make, the big money on. But stablecoins is the most important thing in my mind to understand in crypto right now. I'll tell you a few reasons why. Number one, stablecoins is the best product we have in crypto right now and is rap changing, and not many people are paying attention to that. And I know that because whenever I talk to people about stablecoins, they're still using USDC and USDT mostly. And also in our business, we use stablecoins every day, and we also see people are still using USDT and USDC most of the time, and that needs to change. And then also we got to talk about this because a lot of you are investing in stablecoin protocols. You're investing in Maker, and you need to understand what is going on with stablecoins right now and what's going to come in the future. And a lot of today's conversation is about the architecture of money in the banking system, and understanding that will help us understand the future. And then finally, if you are managing a treasury, either yourself or you're involved in a business, or you're an owner of a business, or maybe you're just part of a big business and you want to go tap the CFO on the shoulder, everybody needs to be understanding on-chain treasury management. And so that's another important point. And then finally, I made this episode for my mom because I was talking to my mom last week, and she was like, stable coins, like she doesn't understand how you can get yield off stable coins and it's risk managed yield. She can't wrap her head around that. So I needed to make this shout out to my mom because this episode's for you, Mom. So in order to have this conversation, we brought on one of the best builders in the space, Tarun Gupta from Coinshift. Now, first, he built Coinshift, which is a leading treasury management software for bookkeeping and accounting on chain. Over 1 billion is managed through Coinshift, used by Aave, Gitcoin, a bunch of leading institutions use it. And then he spent the last year, him and his team, building a new stablecoin, you guessed it, in order to improve treasury management in a risk-adjusted way. So we had to bring on Tarun because he knows this stuff better than anybody. Now, before we jump in, wherever you guys are listening, please do me a quick favor, smash the subscribe button, give us a like, give us a follow. And if you really are feeling good about the bounce right now and crypto being so back, give us a rating. I hope you give us a 5-star, but honestly, give us whatever you guys want to give us because it helps us learn more about what you need in the show and also helps us get better guests and grow the show. Today's episode is brought to you by Definitive, the only place to trade like a pro. You're going to hear about more from them later on in the show. Without further ado, Tarun, welcome to the Milk Road Show.
Thanks, Jay. Excited to be here. Thanks for having me.
Yeah, excited to have you. Okay, I got to start with, before we jump into stablecoins, what a weekend. We ended last week on Friday with everybody thinking, it's over. We were dipping below 80K Bitcoin. It was red everywhere. And then we bounced back. Trump puts out a tweet saying that we're going to get a crypto reserve in the US and that it's going to include Solana, XRP, Cardano. That's actually only 3 tokens, he said. And then he follows up with another tweet and says, and it's going to include Bitcoin and Ethereum too. And he says, I also love Bitcoin and Ethereum. And boom, everything bounces back hard. We're back heading up, back in the green. I think, we've established a nice new floor is what it feels like here, which is very important because we talked about last week in Friday's episode with Jamie Coots from Real Vision about how we didn't really know where the floor was as we were falling here. We knew there was a floor at 70K for Bitcoin, and every other altcoin had basically tipped below their 365-day floor. So we weren't really sure where we were going. There's a lot of fear, but we've clearly established a solid floor and we're coming back up, which is really exciting to see. Tarun, what are your thoughts on the current market?
Yeah, I think like pretty roller coaster going on, right? But I would just say it's more of like, this is the moment, right? Like from last decade, we have been waiting for these kind of moments where actually countries like US and others just put these things like BTC ETH on their balance sheet as reserves, right? So I'm actually living this. To be honest, I'm enjoying this. How we all have thought about it, and now the time has come. So yeah, I think I'm very excited, and I see like more countries will follow the same. Because end of the day, right? Like as a country, if you are making your currency stronger, is as good as your reserves. End of the day, right? And BTC, ETH, and couple of others, as Trump mentioned, is like going to make everyone, every country like pretty solid. So yeah.
If you're only trading on centralized exchanges, then you're not going to make it. The best traders know the alpha is on-chain. Definitive, founded by Coinbase alums, lets you trade any token on Solana, Base, or any chain all in one platform. What makes Definitive different is its advanced order types. You can execute limit, TWAP, and stop loss. Plus, you get the best prices as your order is routed instantly through every DEX and liquidity pool, getting you up to 19 times lower fees. Trusted by funds, whales, and the milkman himself, now you too can trade like a pro. Milk Road listeners get a tasty glass of milk with zero fees on your first 25,000 at milkroad.definitive.fi. The number that I saw that really stood out for me over the weekend was comparing crypto adoption and particularly Bitcoin adoption to social media and the internet. So Bitcoin, it's tough to know the exact number of humans that own Bitcoin, but roughly 250 to 300 million people hold Bitcoin. That's about 3% of the global population, okay, today. So for anybody out there who thinks that like it's too late, like I'm late to the party, no. We are so early. Do you know when the internet had 3% adoption? 1997. 1997. We are in 1997 in internet terms. So it's so early that sometimes when you're in this market and it's so volatile and it's so scary, it's very easy to quit, basically, like hit the emergency brake and get out. And please just don't make that mistake. I just want to celebrate today for everybody that's stuck around for these last few weeks. Way to go. You're still here. Good times are coming. Now, look, I'm not saying it's not going to be volatile. There will be more pullbacks and there will be more dips, but we'll be with you all through that. Okay, Tarun, let's talk about stablecoins. Give us what's the current state of stablecoins when you look at the numbers? Because the numbers are so impressive when you look at them. And I think most people aren't looking at how big stablecoins are getting right now.
Yeah, for sure. So think about right now, like I think it has crossed 200 billion in total market cap, right? And obviously out of that, USDT is the leader here, but because of US Trump administration is here, like we can see USDC at I think 56 billion plus, right? That really speaks the volumes of what they have been doing for the last decade. And then once the regulation is more sorted, I believe like they are literally going to touch like $1 trillion, right? In the next couple of years. So because once regulation comes, like things go super fast because more sophisticated players can easily start putting USDC on their balance sheet. And then to be honest, like right now there are like 53 plus stable coins if you see the landscape, and everyone wants to launch their own stable coin. But how I'm seeing the pattern here is like there will be a good division in terms of like the money use case where okay you want to put your fiat currency on blockchain, and then you want to utilize blockchain for faster, cheaper, and better, right, as compared to normal internet money, right, and or e-money you can say. But on the other hand, obviously there will be more yield use cases where people can make money on top of these stable coins, and that is the second pattern. Maybe we can discuss more in depth, but yeah, these are the two use cases. And so far, we have seen the money use case pretty successful, right? The cross border payments or the payments. So Coinshift has been like doing almost $1 billion in payouts in salaries, contributor payments, etc., etc. So I think that use case is going to explode with Stripe and others. But then I'm more excited on the yield use case, which we can go more deep, like literally helping people earn more money. Think of it like a biggest on-chain account, right? So yeah.
I just want to pull up a chart here quickly, or a visual that you put out recently, just to like really make the point of why stablecoins are so valuable is the let's just explain the traditional cross-border payment rails versus the stable coin. And the reason why I think cross-border is so interesting, I don't know if you listened to the Stripe founders recently were on the All In podcast, and they talked about how they like Stripe settles about 1% of global transactions, over $1 trillion every year that they're settling. And they were like, yeah, stable coins make so much sense. This is a no-brainer. It's going to happen. So if you're not seeing this, and there's so many use cases for stable coins, but just explain this one to us.
Yeah. So if you think about it, right, end of the day, when you want to move money in your own jurisdiction in a local environment, yes, you have like certain kind of capital controls. If one bank can literally sync with another bank very very easily, and you can move money at a very cheaper rate. And for example, in US, even in India with UPI, the money movement within the country is very cheap to move, right? It's not a problem. Even like you have some still capital controls, right, so that you can't just move like billions of dollars without any risk management in place. But when it comes to cross border movement, right, then imagine you need to settle multiple ledger entries, or bookkeeping entries, you can say, and you need to do a lot of reconciliation at the global level, right? And that has a lot of these intermediaries in between. And because of that, obviously, because everyone is taking risk in between from originating to the end, right? Uh, and it means like they are going to charge some percentage of that, because that is what fraud protection and risk management looks like in movement of money. And because of blockchain, this risk management layer especially, right, is taken care by the network. Now you just need to sort of move money as you move your data, because the risk management layer is on the blockchain and nodes and decentralized networks like Ethereum, Solana, etc. Right, and that's why it's so easy to move money in blockchain. You don't have any intermediary, and even if you are sending like $10 on 10,000 or 10 million, it's just a data on the blockchain, right? Rather than you're taking the risk of all these amounts. And that's why I think players like Stripe are like super bullish, and they bought Bridge recently, right? And end of the day, what Bridge is doing is moving in and out from USDC like stable coins across borders very very fast. So I think this is the future, and there is no doubt why banks even don't integrate with blockchain to move sort of stable coins, right, for settling money. It just doesn't make sense to use that old Oracle database and settling ledger all the time. And blockchain has inbuilt reconciliation. This is like a super important point to understand, as like if the another bank really want to, like, let's say, receive the money, they can always say, if there are 10 plus block confirmations, I will accept this money, right? And now you are relying on blockchain rather than the in between bank. So blockchain is solving reconciliation, solving settlement, solving at a lightning speed. So yeah, it's just a better system.
It's just it's so obvious, right? Like it is so obvious. And it's funny because when things are so obvious, they tend not to get a lot of attention, and they tend not to be very exciting. I mean, you
Yes.
said yourself to me before when we were prepping for this episode that you want to make stablecoins exciting. Like you want everyone to be paying attention to stablecoins, and a lot of people just aren't that excited about it because it's kind of become accepted and like the norm, especially within crypto. But I think the thing you need to remember is stablecoins are not accepted and not the norm outside of crypto. And there is so much money that is in cash that is getting very low yield. And we're going to talk about why stablecoins offer better yield and how they do that in a risk safe way later. But one thing I just want to talk about first is what's interesting to see is who when you were doing some research, you were looking at who is using stable coins, and you had some very interesting examples. Who's actually using stable coins outside of like the crypto natives?
Yeah, I think it's like people in Indonesia, let's say you want to accept money through, you're providing some freelancing services, etc., right? You can literally have a wallet, crypto wallet, and you can accept the payment without any intermediary. And because of that, you're just saving like 2% of Stripe fees very easily, right? And if you have a local rails of converting, let's say, USDC to your local currency, at 1:1 or maybe some friction, like very little fees, you will be always preferring that versus actually paying like 2.7% or even more to Stripe, etc. Right? So I think for any merchant where these stable coins are legal, it makes ton of sense to actually accept this. But more than that, I think we have seen like a salary use case for cross-border sort of employees, because every crypto company is majorly multi-entity, and then they have employees or contributors all around the world, right? It just doesn't make sense at one point to actually use banking infrastructure. You might not find like a great banking infrastructure in all the jurisdiction you are hiring for, and that's where USDC just works, right? Because it's on blockchain, so it's so easy, and that's how I think Coinshift like platform has processed almost like $1.5 billion, and there are other platforms who have processed almost same. So billions of dollars are getting moved actually for the real value. So all use cases we see in the neo banking world, right, where you want to accept payments, expense management, contributors payment, etc. All these use cases we have seen, and even people are using like Coinshift for the exact same reason they're using Bricks or Mercury or any other neo bank, basically.
Yeah, it's really interesting to look at all the use cases of stablecoins. So we've got cross-border remittances, movement of money across border. Okay, makes a ton of sense. A very small percentage of cross-border remittances is currently using stablecoins. Massive growth potential. It's like that's a done deal in my mind. It's just going to take some time. We'll talk a little bit about regulation and what will lead that. Then we've got people who are living in countries where their currency inflates at a rapid rate. Argentina, Venezuela. Okay, great. You want to hold US dollars instead of holding your own currency to protect your wealth. Okay, here's a way that you can do that with stablecoins. Then we've got the company treasury, corporate treasuries as the other big use case. And as we said, right now, corporate treasuries using stablecoins is mainly crypto corporate treasuries. They're using stablecoins. But what happens when Amazon's corporate treasury or Facebook's corporate treasury, Meta's corporate treasury, which has, billions of dollars in cash, says, "Oh, I can hold this cash in a stable coin and get much higher yield on it." That is also coming. So the use cases are far and wide. Can you explain to us, let's take a step back for a second. Can you explain to us like the architecture of money and what the different layers are of our current money system? Because I think if you understand those layers now and the current state, then it'll help us understand the future state.
Exactly. So end of the day, right? Always throughout like history, what we call it money is generally like backed by something, and it's generally like all these institutions, especially custodians like banks, they always promise you to give like a higher level money in exchange for this. So for very very long time, our currencies like fiat currencies like US dollars and others like backed by gold. So if you have like X percentage of reserves, you can back that currency through a paper currency, right? And you can always redeem as long as the reserves exist, right? But the always promise is, okay, there is some higher level money which is protecting you, the money you hold, right? And that is the promise all these institutions have done so far. And then we have seen in like during 1930 and World War time as well, like the system has changed, and system has literally became like more debt backed, right? And then more fractional reserve backed, where you just don't only have like gold reserves, you have like more inflationary system, right? And we don't need to go like too much deep into that, but end of the day, the simple gist is the way architecture of money works is when you hold something like US dollars, you are getting a promise from that bank, so that when you want to redeem that dollar, right, you will get like $1 against that, right? And this is like a simple promise. And under the hood, that bank is managing like reserves or doing a lot of credit and fractional reserve and generating ton amount of revenue which you don't know, but the promise is done. And then in a banking system, if everything breaks up, right, especially in US, yes, there is a Federal Reserve which can come in and jump in, right? And then there is like banking licenses and full regulation, what you can do with the customer money or not, right? And that's why it's so hard to get a banking license, right? It's very like these days it's very easy to build a new bank on top of existing banking system, but you cannot just build like a new bank very easily, right? So so I think based on this architecture, if we start comparing the same architecture of, can you create a similar kind of money on blockchain, right? Which has all the properties of blockchain, but has all the properties of money as well, which I explained, right? And this is where Circle did this thing. Like they launched USDC, which is end of the day is promising you to give $1 at any given time when you want to redeem it. But end of the day, they are not a bank, right? They're not a bank. They are just a money. They have this money transmitter licenses and couple of other licenses. And what they are doing is they're keeping those. They're basically having dollars in the bank account or in short-term treasuries or a couple of other instruments, right? And they're representing that entire reserve management to the promise to give you one USDC. So when you go to them, and if you have a Circle account, you can always take one USD out of that. But this architecture in itself is a very unique thing, because if you apply this now architecture to USDT, they are not saying, okay, it is only backed by cash equivalents or US treasuries. Yes, they are the largest holder of US treasuries as well, but they have BTC as well. They have bare metals as well. So, so this architecture itself has this innovative way to have better reserve management, right? You can innovate a lot on the reserve management, maybe better than the current banking system, and you can represent that entire system with one token, which is could be USDC, USDT, or etc. etc. So I think I see the future of architecture of money, or the money is just this unique representation of these reserves, and these reserves can be well managed through regulation. Yeah, we can. Yeah,
Yeah,
please.
let's just talk about the reserve management side, because I think everybody assumes that banks are safe, right? That's just like this general assumption. But there are problems and there are issues with our banking system, even though the system has been built to tell us, like, oh, we're all safe. So, talk about some of the problems. What are the problems with the current banking system?
Yeah, I think other than just movement of money, I think the number one problem I see from the depositor angle, let's say your mom is putting money or
Mhm.
saving, or you are putting money, you actually don't know what's going on under the black box, right? So they are taking your money, and then it's not like, okay, they always have you have like full transparency of, you always have one sort of dollar against your money, right? They might be doing like lot of under collateralized loans, right, which you are not aware about, and that's why we have seen problems in India and in a couple of other countries where banks have like defaulted multiple times, and end of the day you are using that currency, but you want to go to the bank and give me my money back, and they don't have, right? And I think the number one reason I see is like not transparent at all, and transparent by a virtue of function, right? Yes, you can have a banking license, you can obey all the laws and all that, but end of the day you are doing reconciliation every single day, and you can do certain things, and maybe the fraud will be detected at some time which you don't know, then there will be a lawsuit, and then you know but in blockchain you just can't do that. If you are very clear in terms of like, obviously if it is like fully regulated, we can talk about the regulation in stablecoins as well, but end of the day, like stablecoins like DAI, for example, let's say, or what we launched recently, CSUSDL, you can check out the reserves on chain, right? You
Mhm.
cannot lie how much DAI or USDS in circulation. You cannot just lie about it, right? So I think this is the power of blockchain versus the traditional finance. Yeah.
Yeah, there is a big aspect here of trust and verification, right? With our current system, you you basically, there's no verification. You do not know the way the bank is holding your assets, what they're doing with those assets, how much risk they're taking, right? And then you also just have to trust them, basically. Hey, you're a regulated bank. I trust my government, therefore I trust you indirectly because of the regulation. And let's be real, these regulations are outdated, they're old. And how often are each of these banks being audited? not often enough, and it's too complex and too difficult to actually audit them properly. So what that leads to is, as you said, it leads to this problem that we're in right now, and it's not really discussed enough in my mind. Is banks default, and that impacts the end users and puts us in a very, this is not us protecting our people and our citizens and helping them thrive. This is us supporting a banking system and propping it up in the wrong way. So, okay. So where that leads us to is, stablecoins are going to provide a trustless way that you can verify, you can see what is actually happening with your dollars behind the scenes. But let's talk about the regulation for a second here, because we're at over 200 billion in stablecoin volume, but we still don't really have regulation yet. What is the state of regulation? What's going to happen there?
Yeah, for sure. Just one thing I will mention on the previous thing is like transparency brings a lot of competition at a fair ground level, right? If if one party is like very, very transparent, then other banks need to be more transparent. Otherwise, they can't just compete because user will always trust the transparent company or a bank, right?
Yeah, so no, I fully agree. Like, the innovation, transparency breeds innovation, which will lead to the best product for the end user, right? And that's what we're seeing in stablecoins right now. I want to talk about regulation. What's the state of regulation?
Yeah, I think before this Trump administration, I would love to like talk about governments like Abu Dhabi, right, or in Singapore. I think they have gone really, really far in terms of understanding how to actually tokenize these digital assets or any kind of value on chain, right? And I think what we have seen last year as, for example, if you know about Paxos, Paxos is one of the largest stablecoin issuer. They work with PayPal, Mastercard, etc., etc. And last year they launched a stablecoin called USDL based out of Abu Dhabi, and it is fully supervised by Abu Dhabi government. Right? What does it mean is they are working with the government to regulate a T-bill backed stablecoin on chain, and they're going to represent that T-bill interest rate on the blockchain through rebasing mechanism. So think about the state of regulation right now is the government is excited to understand the power of smart contracts, and they're working together. Okay, rebasing mechanism is actually not possible very easily in TradFi. They're utilizing that mechanism very similar to ST-ETH in Lido's case, right? So through that rebasing mechanism, you are representing the interest rate of a treasury bill, right? And for the end user, they are just holding $1, one USDL. With $1, they can hold like a T-bill asset, and that USDL will always be redeemed to $1, and it's the promise of the government, right? Not like only Paxos, right? So when you see these kind of things, I think Mountain Protocol has done like a similar job in Bermuda, I guess, if I'm not wrong. And so the governments are getting excited in terms of, okay, let's try to bring all these financial instruments on chain, and this is very, very exciting. On the other side, I think Super State also is doing great job. It is also supervised. They have this T-bill backed like fund, right? USTB, which is already 300 million plus, so it is fully regulated in that sense. And then on the other side, you have USCC, which is a crypto carry fund, more of a margin and basis trades, but at the same time, it's a fund which is like supervised, right? So what we are seeing last year is you can apply all the innovation of a smart contract now to fiat backed sort of value creation instruments like T-bills and crypto carry funds, etc., etc. And you can supervise that as well, right? It was the beginning before this Trump administration, but now I think my sort of intuition is after this, I think all large asset managers, if you see, BlackRock is already doing that with Securitize, right? They have regulated that entire Budel and you can redeem it through USDC, right, very easily. And we are seeing like more Franklin Templeton is also doing the same thing. So I think Fidelity is also getting very active. So I think these large asset managers are also realizing, okay, now why we need to use the banking infrastructure? We are perfect in managing risk. We are perfect in managing clients' money. Why don't we just utilize this blockchain infrastructure and then get fully regulated? Because all these institutions want regulation, right, on their before putting money on their balance sheet. And so I see this kind of pattern emerging, the more sophisticated asset managers, governments are coming into it. And after, I think, the stablecoin regulation, you will see they will go more aggressive. They're starting out with very small things. Right, $1 billion for BlackRock is literally nothing. Right, so imagine once it is regulated, they have like $10 trillion AUM. Right, I don't see the reason of that managing into a banking infrastructure. I literally don't see that reason. So that those kind of instruments is coming on chain in the next decade for sure.
Yeah, it feels like there is a couple of trends converging at the same time here. One of the big trends that we've talked a lot about recently and over the past 6 months is institutional adoption. And the institutional money really is not here yet. Yeah, sure, there's some of it. You mentioned some of those names, but it's, as you said, it's like there's only a fraction of the institutions are here. The institutions that are here, they're only taking a fraction of their dollars and putting it on chain because the regulation isn't here yet. So there's institutional adoption is growing rapidly, plus the regulation is happening and coming right now. And so those two trends converging at the same time should very likely lead to an explosion of stablecoins. And the wild thing about stablecoins is when you look at the chart, it's almost up only. Yeah, we've had a few dips, especially around FTX and that scare, but stablecoins don't disappear in the bear market like everything else. Price action and the speculators, that dips hard, and that's always tough in the bear market. But stablecoins continue to rise at a consistent base. So I think what is going to happen is we're going to see just an absolute explosion of stablecoin uses. And one of the other reasons why we're going to see this explosion is there's also a lot of innovation happening. And this is the next thing I really want to talk about on the crypto side to offer yield in your stablecoins. Right now, most people are just using Tether and USDC, which do not offer yield. They're amazing at solving one of the issues of that we identified, one of the use cases with stablecoins, but they don't offer the yield yet. Where are we at with yield bearing stablecoins right now, and what's coming? And feel free to talk about CSUSDL, which is your stablecoin that you have launched recently, because that might set some context.
For sure. I think before we get into CSUSDL, I really want to credit a lot to Circle first, in terms of right why they are not giving a huge amount of yields to the end user. So one thing we need to really understand is like they are solving this simple use case of money. And when you think about money, you want to move in and out of the money. So think about a time when you have a lot of cash, let's say, right? And then the digital banking just started, right? So for the end customer, they have cash, they believe in cash, and they also started to slowly believe in the digital money, which is like internet e-money, right? So they will not convert 100% of it on day one, right? Practically, you have not done it. I have not done it. None of us have done it, right? Because we still know because the some shopkeeper will always accept the e-money right now. So it is a similar era, and that's why because not everyone is on chain, and if you want to solve a money use case, it means you need to enable a lot of redeemability of that so that customers and institutions are really comfortable to get in and out of dollars. And this is what Circle has been doing, right? So they are not putting like everything to really generate yield. You need to actually your asset becomes like literally illiquid to redeem, right? End of the day. Even if you have all the money in US Treasury bills, there is like T+1 redemptions, right? You cannot just immediately redeem everything out. And that's why I think it's a huge credit to them. They're making and optimizing more on the liquid side so that you can go in and out very easily. And if you go to Circle website, they are intentionally showing on the transparency page like how much is redeemed actually last 7 days, right? And once as a customer or a very large institution, you start feeling I can go back to dollars very easily at such a large scale, you might not even go. You might not even think about going back, right? And that's how the trust comes, right? And obviously, they you can check out their transparency reports in terms of where they're putting the money into short-term, long-term treasuries, right? But end of the day, they're not optimizing for the yield. And they recently acquired USYC, which is like a T-bill representation, right? And for that, you are going to generate like T-bill rate very easily, and they must be doing something related to that. So I think Circle with USDC is not optimizing for the yield use case. They're optimizing for the money use case, and that's how they are going to be very successful, in my opinion. But now on the other side, I think there is like not a very good like regulatory clarity on passing the T-bill yield directly to the user, and it is not like fully regulated, this kind of instrument, and that's why Paxos launched USDL not out of US. They launched out of Abu Dhabi because Abu Dhabi government regulated that yield, right? So first thing is like it's not that straightforward. It's not like Circle don't want to do it, or they can't do it. It's just that it's not legally, like right now they can't do it legally, right? So yeah, I think that is like one aspect. But at the same time, I think we have seen huge amount of yield bearing stablecoins growth, and majorly there are two categories I see. One is like, okay, you are just launching a T-bill backed asset, for example USTB, Ondo, I think USDY. These are like T-bill representation. These are not as such stable coins. These are T-bill backed instruments, right? So your end of the day, your yield innovation is just fixed as compared to like, okay, it's only T-bill. But on the other side, what Paxos and Mountain Protocol are trying to do is they are innovating its stablecoin representation. Today it is backed by T-bills, plus it can be backed by more cash equivalents in the future, right? So they're replicating a USDC kind of structure, right? But also representing the yield on chain. And this is where I was like really amazed when I was doing the research. Okay, right? They are actually innovating on the base layer. And today, if you see no stable coin other than these two, USDL and USDM, nobody gives you the yield on the base layer. You need to stake, you need to lock, or you need to do something extra to get the basically yield, right? In case of MakerDAO, majority of the funds are not staked actually, and that is the number one reason of huge revenues of MakerDAO, right? So I think when I was doing the research, the main thesis was, can we build a stable coin which gives the yield to the end user without doing anything extra? And that's why we sort of tried working sort of with Paxos, and we have like a partnership with them. And that's why what we did is like we take this USDL, right? We're putting into a lending protocol by default, and user is able to generate. So I'll explain now CSUSDL, what is sort of CSUSDL. So CSUSDL is a yield bearing stablecoin backed by USDL and CBBTC and STE, and in the future more RWA regulated collaterals, right? And what does it give to the end user is our promise is you will get minimum T-bill yield on this asset without additional lockup, and an additional lending yield similar to MakerDAO like system, right? But in a single asset without additional lockup. And imagine you will be able to borrow against that very easily. So imagine you hold CSUSDL, you can borrow USDC against that. So you can do leverage whatever you want to do, or maybe you want to buy property, etc. And then you can go in and out in a permissionless manner. So this kind of stablecoin does not exist right now, which has all the properties of MakerDAO and all the properties of sort of USDC, and in a single asset without additional lockup. And that is our value proposition, and that's why we are growing very fast. But yeah, this is like what we are doing.
So the question that always comes up when it comes to these yield bearing stable coins is the risk management, right? There's always that fear of, okay, great, you're offering me 10 20% yield. You get very high numbers. I think right now with CSUSDL, I think you guys are up in the 30%, right? Which like makes a lot of red flags go off, right? Like a lot of people are like, whoa, that's not possible. How can you offer that yield? Talk to us about the risk management side.
100%. And first of all, like that 30% plus is including Morpho and then upcoming shift rewards, right? So we don't have like a point system. We want to be just more transparent with the end user so that they can speculate on based on the FDV calculations. So right now, like I'll talk about the native yield first without involving shift rewards or Morpho rewards, right? So right now that native yield is around like 6-7% basically, where you actually like put money directly into CSUSDL, you can swap it, whatever, and then you get this yield. And all the time you can earn this yield basically, and the rest is very transparent because it's a Morpho protocol. They are already like one of the largest lending protocol, like I think the second largest, right? And on the other side, it is USDL and under the hood, and USDL is fully regulated by Abu Dhabi. So it's a very low risk strategy, right, in terms of like getting yield. And then on top of it, because we are bootstrapping this asset and we have over $1 billion in asset under management in our B2B solution, we really want to grow this asset quickly to 50 to 100 million first. And that's why there are huge incentives for the early adopters. And majorly this asset and stablecoin is adopted by like large institutions and market makers at this stage. And once we surpass, let's say, $100 million, then we want to enable it to all treasuries to rather than holding USDC in your balance sheet, right? Because you're not going to transfer 100% of your USDC to employees every single day. Why are you not earning minimum 6 to 7% yield, which is very, very low risk, right? And who is managing the risk of this entire stablecoin is Steakhouse Financials. They have like huge experience in working with MakerDAO. They're 2 billion plus RWA program. They work with all like major DAOs as well, like Lido, etc. So they're managing with us this asset, and that's why we are like very confident. It's a low conservative risk strategy, but enough competitive yield. Plus, it is highly liquid in the secondary market, and you can borrow against that. So I think we're trying to replicate basically the treasury bill like asset on chain, so that you can always pledge it as collateral and you can borrow against that. So you don't need to sell it, basically, right? So that is like the idea behind that and the yield explanation.
I think so. Do you where does this all go? So what's the end state that you see 5, 10 years from now? And I think that the reason I ask this question is like what's really important to understand as an investor in this space is where these big opportunities, where these big products are going to come from within crypto. And obviously, we all know Bitcoin has achieved product market fit as a store of value. Okay, great. Stablecoins have also achieved product market fit, but still pretty small. Like it's much smaller than Bitcoin, right? So, where does this all lead to?
Yeah, I think obviously the innovation is very hard to predict, like how it will look like. But I think I'll try my best to really predict. So what will happen is, I think all these, like all the market cap of e-money, right? If it is like 25 trillion plus or more, that has to come on chain. There is no other way you are going to use your banking infrastructure, right? So that is like first simple explanation of why trillions of dollars will come. And once they come on chain, they don't want to go back, right? Now, how you see about cash, right? You don't look cash as the similar manner 20 years ago, how people used to see cash. So it will be very similar, like you everything is on chain. And once money is on chain, because blockchain works block by block in a time delay function, it means you can generate yield block by block, right? And all those assets will be generating yield, in my opinion. And whenever you want to move that asset, you either exit out of it or you borrow against that. So that is the future we see. And then because you will have all degrees of risk management, right? You will never consider a T-bill backed asset versus a margin trade asset in a similar risk category, right? So these are like different risk profiles, I would say, and it's up to the institutional investor or user or treasury managers how they will categorize this. But my thesis is like your capital should be hyper efficient and should be earning yield for a single block even, right? Why not? Because you can earn it. This is like magic, right? So you should earn that yield. And this is where CSUSDL is heading. And we want to become like the ultimate treasury reserve asset. And all these like billions of dollars should be earning at least 7%. They deserve it, right? So yeah, I think this is the future.
Which sounds awesome. You say at least 77%. Like nobody's getting at least 70% right, 7% right now. So that's fantastic. I think that like the other thing is traditional banking is so slow and crypto moves much faster. And obviously there's a balance here of slowing down innovation in order to let regulation catch up. And so there will be a balance, but there is a speed. We've never had the financial system innovating at the speed that is innovating now. It's been a long time. You could argue that fintech did cause a lot of innovation, but not to the scale of affecting the entire system the way that blockchain and crypto is reinventing the system. So there's also just this like speed of innovation that is happening so quickly. And I think from the outside, you don't see it. So you don't really realize that speed. But the other thing that really stands out to me about everything that you're saying is just how most of these stable coins and a lot of the yield is coming from RWAs. And I hate the term RWAs. It's like, what does RWA even mean? But it's coming from T-bills. It's coming from these regulated assets. So that's where I think a lot of the risk management comes from, is that a lot of this it's not like it's yield that's coming from, some algorithm or some crypto asset that's incredibly high risk. It's coming from regulated real world assets that are safe and that are trusted, and it's just being done in a new innovative way. So yeah, I think it's such a no-brainer. It feels so obvious. And so if you're if you're managing a corporate treasury, start to learn about stablecoins. We took a big portion of our corporate treasury at Milk Road and put it into stables, moved it from fiat into stables, and we're not going to take that back so that we could get higher yields, right? If you're thinking about what to do with and I know everybody listening in is like, I'm fully allocated, I'm investing right now, I'm in speculation mode, and that's fine if that's what you're doing. But eventually in this cycle, you are going to start to take some profits. And where do you take those profits to? Sure, maybe you need to take some back into fiat in order to pay taxes and stuff like that. I don't think your government's going to accept stable coins quite yet to pay your tax bill, maybe in the future. But with some of it, you might want to take it into stables because there's going to be great yield there. And then the final thing is like when savings accounts really start to become, and I think we're closer to that. There's a lot of steps you need to do. Basically, if you wanted a stablecoin savings account, you would also need to learn how to have a on-chain credit card where you could spend your cash from on-chain and spend your stables to buy coffee and do things in the regular world. So you need a couple more steps here, but all of that, we're in that world. We're so close there. It just feels like, I think you're dead on when you say like, we're going to be at trillions of dollars in stablecoins faster than we know it.
Exactly. And I think all these manifestations, I would say, since I'm in the industry since 2017. I actually came in the industry just to like really love all these use cases, right? And now seeing everything working, it just excites me, and to actually build in a permissionless manner, right? Whether in any other world, you can't just work with like for example, Steakhouse, Paxos, and Morpho like this way we are working, right? It can only happen because of the blockchain innovation, right? So yeah, I think it's just fascinating. All this is coming into life now.
Yeah, which is another reason why the speed of innovation is so fast. Like this open
Exactly.
source permissionless building we've never really seen anything like this, and that we could do a whole episode on that. Tarun, it's been an absolute pleasure to have you on the show today and sit down with you and to get your take on the stablecoin thesis and where we're headed. Thank you so much for joining us.
Thank you so much. Thank you, Mom. It's a pleasure.
Everybody listening in, appreciate your time. I want to know, everybody listening, which stablecoins are you guys holding? I'm guessing it's mostly USDC and USDT, but are you guys holding any other ones? Which ones are you using? Let us know in the comments, because it's always very interesting to know what you guys are using, and then we can make sure we help you with those assets. Thanks for listening in, everybody. Have a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.